You know, when we look around at the sheer scale of the modern world, the towering skyscrapers, massive global shipping lines, or just the fact that you can drive down a highway at 60 miles an hour, there's this comforting illusion of total control.
Oh, absolutely. It's an incredibly seductive illusion too.
Yeah.
We really like to believe that if we follow the rules, maintain our cars, build our structures to code, that everything just remains perfectly predictable.
Right, but then you look just beneath the surface, underneath all that concrete and steel, and you realize there is this invisible, highly complex safety net that is constantly catching us.
Yeah.
We're looking at a legal and financial architecture built entirely to deal with the terrifying, unyielding randomness of the universe.
It really is the ultimate social mechanism for, mathematically sharing disaster.
Yeah.
Because without this mechanism, modern civilization, global trade, everyday commerce, it all basically grinds to an absolute halt.
Which brings us to our topic today. Welcome to another deep dive. Today, we're taking you on a journey through a subject that might sound a little dry at first glance, but is secretly thrilling.
Yeah.
We're talking about insurance law.
Yes.
And we're pulling from an incredibly comprehensive academic compilation on the subject, which was prepared by the KLE Law Academy Belagavi.
And it's worth noting this specific material bears the KLE centenary emblem.
Oh, right.
Yeah, it proudly celebrates over 100 years of selfless service.
Mm-hmm.
So it serves as a really foundational text, guiding students through the intricate legal frameworks of risk, liability, and protection, both in India and globally.
So our mission for you today is pretty ambitious. We are going to transform this dense legal syllabus into a fascinating exploration of human psychology, the mathematical valuation of life, and the shoe mechanics of risk.
It's going to be a ride.
We're going to decode exactly how humanity learned to mathematically share the burden of catastrophe. So, okay, let's unpack this.
Well, to truly comprehend that invisible safety net you rely on every day, we have to examine how humanity first approached the chaotic reality that bad things happen to good people.
Right.
The urge to pool risk isn't just some modern corporate invention. It's a foundational survival strategy.
Yeah, the sources point out that long before the concept of a multinational insurance conglomerate, the roots of this mathematical risk sharing actually appear in ancient Indian texts.
Exactly.
We're talking about the Manusmriti and Kautilya's Arthashastra. These texts were already laying down the philosophical groundwork for how communities could pool their resources, to redistribute the devastating economic fallout from floods, epidemics, famines, things like that.
And those early frameworks, they essentially operated on community algorithms.
Mm-hmm.
They didn't have actuarial tables, obviously.
No spreadsheets back then.
Right, no spreadsheets. But they understood the core concept of mutual aid. However, the evolution into the commercial framework that actually fueled global trade, that required a shift from mutual survival to, calculated financial risk.
And that shift happened when exactly?
It really crystallized in the 1680s in London at this place called Edward Lloyd's Coffee House on Tower Street.
Okay, so literally a coffee shop.
Literally a coffee shop. You had ship owners, merchants, sea captains, all gathering there to just, share the latest maritime intelligence over a drink.
So a merchant would essentially stand up and say, hey, I have a ship laden with spices heading to India. Who here will share the financial devastation if it ends up at the bottom of the Atlantic?
That is exactly what happened. Various people would review the proposed voyage, calculate the danger in their heads, and then sign their names underneath the proposal.
Oh, underneath. So they literally became underwriters.
Yes, that's exactly where the term comes from. They were agreeing to take on a specific percentage of the financial risk in exchange for a premium. This sort of ad hoc gathering of maritime speculators birthed the colossal insurance market we now know as Lloyd's of London.
Wow. But, if we isolate the core mechanic happening in that coffee house, there's a fundamental tension that emerges. You are paying someone a small sum of money, and if a specific highly uncertain event occurs, you get a massive sum of money back.
Right.
Conceptually, how is paying a premium for a potential payout any different than just placing a bet at a casino?
It's a great question, and early courts wrestled with that exact dilemma because early insurance contracts often blurred the line into blatant gambling.
I bet.
So the legal doctrine that was forged to separate a valid, enforceable insurance contract from an illegal wager is called insurable interest.
Insurable interest. Okay, let me frame it this way for you. If I place a wager on a professional sports game, I am creating a risk of financial loss that literally did not exist before I handed over my money.
Exactly.
If my chosen team loses, my wallet takes a hit. But with insurance, say, fire insurance on my own home, the risk of that structure burning to the ground exists entirely independent of my actions.
Yes, that's the key distinction.
I'm not conjuring a new risk. I'm mathematically shifting the financial burden of an existing risk off my shoulders.
And that existing relationship to the potential loss,
Right.
that is the absolute bedrock of insurable interest. The law dictates that you can only insure an asset if its destruction causes you direct, measurable financial harm.
Okay, it makes sense.
If you lack that financial connection, the contract is legally viewed as a wager, and wagering agreements are void. Like, you are legally barred from taking out a fire insurance policy on a total stranger's warehouse, just hoping it catches fire so you can collect a windfall.
Which establishes a clean, logical boundary when we are talking about a warehouse or a cargo ship or, I don't know, a fleet of delivery trucks. An asset like that has a verifiable depreciating market value.
Right.
But how does the legal system underwrite the ultimate variable? Like, how do the courts handle the mathematical valuation of a human life?
That challenge forms the core tension of life insurance. Because for commercial property, the governing principle is the contract of indemnity. Right. Indemnity mandates that a payout is designed to make you exactly whole. It returns you to the financial state you were in right before the loss. Crucially, you cannot turn a profit.
So if a fire destroys $10,000 worth of inventory, the insurer pays $10,000. No more, no less.
Exactly. The problem is, you cannot apply strict indemnity to a person.
Right. There is no ledger that can calculate the exact depreciating market value of a parent or a spouse or a business partner.
And the courts formally recognized this impossibility in a landmark precedent cited in the text Dalby v. the Indian and London Assurance Co.
What did they rule?
The ruling established that because a human life cannot be accurately estimated in monetary terms, life insurance inherently breaks the strict rule of indemnity.
Oh, interesting.
Instead, it is classified as an aleatory or assurance contract. The value of the policy is simply whatever premium the insured is willing and able to pay to secure a specific payout upon death.
But abandoning strict indemnity makes that earlier rule, insurable interest, even more critical, doesn't it?
Oh, absolutely.
Because to prove just how vital it is that a legitimate financial or familial bond exists when a life policy is initiated, the syllabus details this genuinely chilling case.
Yes, the Weldon case.
Liberty National Life Insurance Co. versus Weldon, a profoundly dark moment in legal history.
It fundamentally shaped modern underwriting standards.
So get this. A nurse initiated a life insurance policy on her own 2-year-old niece.
Which is a red flag immediately.
Huge red flag. Generally speaking, an aunt does not possess a legally recognized financial dependence on a toddler. Yet the insurance companies somehow bypassed their own rigorous checks and issued the policy anyway.
They just pushed it through.
Yeah. And shortly after the ink dried, the nurse administered a lethal dose of arsenic to the child.
Horrific.
She manufactured a murder for the sole purpose of harvesting the payout.
And while the criminal justice system dealt with the murder itself, the civil courts delivered a ruling that sent shockwaves through the entire financial sector.
They didn't just avoid the payout, right?
No, the court actively penalized the insurance company for issuing the policy without verifying insurable interest.
Wow.
The judges recognized that by handing someone a massive financial incentive tied to the death of a child they had no financial interest in, the insurer had essentially funded a motive for murder.
They funded a motive.
Exactly. They strictly enforced the doctrine that no man shall be allowed to take advantage of his own wrong and held the corporation liable for creating a fatal moral hazard.
That ruling exposes a unique vulnerability built into the very DNA of the insurance industry because in standard everyday commerce, the governing philosophy is caveat emptor, right? Buyer beware.
Right. If you purchase a used vehicle, the burden is entirely on you to inspect the transmission, check the undercarriage. The seller doesn't have to highlight every single flaw for you.
But insurance relies on the diametrically opposite principle, uberrima fides, which translates to utmost good faith. But wait, relying entirely on the customer's honor system. In modern cutthroat commerce, that sounds like a recipe for catastrophic corporate bankruptcy. Why does the law force insurers to be so legally vulnerable?
Well, that vulnerability is the inevitable result of extreme information asymmetry.
Meaning one side knows way more than the other.
Exactly. Think about the mechanics of underwriting a health policy or a complex property policy. The individual applying for coverage knows every intimate detail about their hidden medical conditions, their reckless weekend hobbies, or the faulty wiring in their basement.
And the insurer is just guessing.
The insurer is completely blind. They have to run complex actuarial math based solely on the data the applicant chooses to provide.
So the law aggressively levels the playing field.
It does. It imposes a stringent active duty of disclosure on the customer. Failing to disclose a material fact, basically, a fact that would have changed the insurer's decision to issue the policy or altered the premium price that can completely void the entire contract from day one.
Even if it was an accident.
Even if the omission was entirely innocent and lacked any malicious intent. Utmost good faith demands absolute transparency.
That makes a lot of sense. So, scaling up from individual malice and personal medical histories, we encounter a completely different category of mathematical danger.
Yeah, industrialization.
Exactly. As society hurtled through the Industrial Revolution, the nature of risk morphed. It wasn't just about a single merchant ship sinking or one person getting sick. You had sprawling factories, aggressive railway expansions, millions of motor vehicles hitting the roads.
The scale of potential disaster became astronomical.
Suddenly, a single business or individual could accidentally devastate massive swaths of the general public in a fraction of a second. So the legal framework had to evolve from negotiating individual contracts into constructing giant societal safety nets.
And the concept of liability itself had to be fundamentally re-engineered. Otherwise, society would collapse under the weight of endless litigation.
Which we see perfectly illustrated in Section 140 of the Motor Vehicles Act, 1988.
Yes, a really crucial piece of legislation.
Next time you're stuck in traffic, look at the cars around you and consider this legal anomaly. Normally, if a driver hits you and you want them to pay your medical bills, the burden of proof is on you. You have to prove they were speeding or distracted or negligent.
Right.
But Section 140 completely bypasses the concept of fault.
It introduces the doctrine of no-fault liability.
Okay, how does that work?
The Act dictates that in the event of death or permanent disablement arising directly from a motor vehicle accident, the owner of the vehicle is strictly automatically liable to pay a fixed compensation. Specifically, 50,000 rupees for death and 25,000 rupees for permanent disablement.
And the victim's family never steps foot in a courtroom to argue about who had the right of way.
Never. They do not have to plead or establish any wrongful neglect or default by the vehicle owner.
That's incredible.
The legal system acknowledges a harsh reality here. Proving negligence in a traditional court of law is a grueling process. It can take years of depositions and appeals. Meanwhile, a family that just lost their primary breadwinner is facing immediate financial ruin.
So no-fault liability isn't about perfectly balanced scales of justice.
No, it is a compensatory triage mechanism. It is designed to inject immediate survival funds into a crisis before the slow wheels of the traditional court system even begin to turn.
And that philosophy of immediate societal relief doesn't just apply to highways, right? Because if you live anywhere near a chemical storage facility, a manufacturing plant, or a refinery, your neighborhood is protected by a similar mechanism.
You're referring to the Public Liability Insurance Act of 1991.
Yes.
The rapid expansion of hazardous operations across India brought an unprecedented level of systemic risk to innocent communities living right in the shadow of these facilities. So this legislation made it mandatory, like a strict condition of operating for business owners handling specific hazardous substances to take out dedicated public liability policies.
So if a toxic leak occurs or a containment silo breaches, the legal framework guarantees there's already a massive pool of capital specifically ring-fenced to provide immediate financial relief to the surrounding public.
Exactly. To the people whose health or property is damaged.
Yeah.
Interestingly, the text notes of this act specifically excludes the actual workmen employed at the plant.
Wait, really? Why?
Because their injuries are handled under entirely separate labor compensation frameworks. This law exists exclusively to protect the innocent collateral damage of industrial progress.
Ah, I see.
It even established a dedicated environmental relief fund. It acknowledges that operating a hazardous enterprise in a modern society requires you to proactively underwrite the survival of the community surrounding you.
Okay, so it's one thing to calculate the statistical risk of a predictable factory floor or accident rates on a paved highway, but how does a law underwrite an asset that is completely exposed to the elements, entirely at the mercy of the weather, and central to the survival of the entire nation?
You're talking about agriculture.
Yes, the mathematical nightmare of agriculture and terrestrial property. Let's delve into fire, crop, and cattle insurance.
Well, fire insurance is an excellent starting point. because its legal definition is fascinatingly broad.
How broad are we talking?
A standard fire policy frequently covers destruction from lightning strikes, aircraft crashing into the structure, civil riots, and even damage from nearby missile testing operations.
Missile testing. Okay, that's thorough.
But it explicitly excludes catastrophic, unquantifiable perils like subterranean earthquakes and nuclear incidents. Unless, of course, you specifically negotiate that with massive premium hikes.
Now, there is a specific mathematical trap embedded in property insurance that perfectly illustrates the underlying logic of the entire industry. It's called the average clause.
Yes, the average clause.
I really want to unpack this because it fundamentally alters how you view your own policies. Think of it like splitting the bill at dinner. Let's say you own a commercial warehouse valued at 1 lakh, but to shave a few rupees off your monthly expenses, you decide to only insure it for 80,000.
So you have consciously chosen to only cover 80% of the true underlying asset.
Right. Now, a fire breaks out in the loading dock. It doesn't level the entire building. It causes exactly 50,000 in structural damage. The average person assumes, well, my policy limit is 80,000, the damage is only 50,000, I am fully covered.
But the average clause activates.
Exactly. The insurer will only write you a check for 40,000.
Because the mechanism is ruthlessly proportional.
Right.
Because you only agreed to pay premiums covering 80% of the building's total value, the insurance company designates you as a 20% silent partner in your own risk.
So it's like buying half an umbrella and wondering why your legs are soaking wet. You decided to co-insure the risk yourself.
That's a great way to put it. Therefore, they will only cover their 80% of any partial loss. You are legally on the hook for the remaining 20% of the repair bill because you chose to co-insure the property to save money on the front end.
It's a brilliant, strict enforcement of the indemnity principle. Now, when we transition from concrete warehouses to biological assets like crops, the government has to heavily intervene to prevent systemic collapse, right?
Yes. The sources detail the Pradhan Mantri Fasal Bima Yojana, or PMFBY, which was implemented to fiercely standardize and subsidize agricultural risk. It locks in incredibly low premiums for farmers. We're talking just 2% for Kharif crops and 1.5% for Rabi crops.
And when you drill down into the specifics of livestock, specifically cattle insurance, you witness the law attempting to govern incredibly granular biological variables.
It is very specific.
Yeah, the policy doesn't just cover death, it covers permanent disability. But disability is strictly defined by the economic utility of the specific animal.
Right.
So for a milch cow, permanent disability is legally defined as the permanent incapacity to conceive or yield milk. For a stud bull, it is the permanent incapacity to breed.
And the mechanisms designed to prevent fraud in these rural, decentralized settings are intense.
Oh yeah, you can't just call an adjuster and say, hey, my cow wandered off and died.
No, the burden of proof is staggeringly specific. You are required to submit a certified veterinary doctor's post-mortem report. You must supply at least 4 clear photographs of the deceased animal. But the most crucial mechanism is the physical identification tag.
The ear tag.
Yes, that physical ear tag affixed when the policy is initiated is the absolute linchpin of the entire contract.
Because without that tag tying the living biological asset to the mathematical risk profile, the system falls apart. A farmer could theoretically present any deceased cow to the adjuster, collect the payout, and then quietly sell their actual healthy insured cow in what the legal text calls a clandestine sale.
Exactly. The strict documentation requirements exist solely to prevent the risk pool from being drained by manufactured losses.
Okay, let's push the boundaries even further, because the ultimate test of risk management isn't found on a predictable highway or a fenced-in farm.
Back to the sea.
Yes. To truly appreciate the complexity of insurance law, we must examine the birthplace of these doctrines, the unforgiving sea, where the legal rules of the game are entirely unique.
The marine environment operates in its own distinct legal universe. Because in terrestrial property insurance, a destroyed building is just a destroyed building. But in marine insurance, the courts have to differentiate between an actual total loss and a constructive total loss.
Okay, what's the difference?
Well, an actual total loss is conceptually simple. The cargo vessel is sitting at the bottom of the Mariana Trench, or it has been utterly obliterated by an explosion. It physically ceases to exist.
Made sense.
A constructive total loss, however, is a purely economic calculation. Imagine a vessel stranded on a jagged remote reef. The hull is technically intact. It physically exists.
Okay.
But when the actuaries calculate the cost of deploying specialized salvage cranes, towing the vessel thousands of miles and repairing the structural damage, that final repair bill vastly exceeds what the ship would actually be worth once it's fixed.
Ah, so the math dictates the asset is economically annihilated, even if you can still physically see it on the reef.
Precisely.
That economic tipping point makes sense. But the maritime concept that genuinely challenged my understanding of property rights is called general average.
Oh, this is a fascinating one.
Well, let me frame a scenario. Say I pay to ship a container of high-end server racks across the Pacific. A massive typhoon hits. To prevent the entire ship from capsizing and killing the crew, the captain makes the agonizing decision to toss my heavy server racks overboard to lighten the load.
A voluntary sacrifice.
Right. So the ship stabilizes and successfully reaches port. Are you telling me that the merchant whose shipment of cheap textiles safely survived the storm now has to open their wallet and pay me for my sunken servers? That sounds like a logistical nightmare.
It sounds crazy, but that is the brutal, forced solidarity of the high seas. The general average is an ancient, fundamental maritime law of equitable apportionment. The underlying logic is profound. If a voluntary, intentional sacrifice is made in a moment of extreme, shared peril to save the entire maritime adventure, everyone who financially benefited from that sacrifice must proportionally share the burden of the loss. Your servers were sacrificed so their textiles could survive. Therefore, the surviving cargo owners legally owe you a percentage of your loss.
We all sink, or we all pay.
That's the rule.
It is a radical departure from individual property rights.
And when you look at the laws governing the rescue of these massive vessels, you encounter the law of salvage, specifically the sue and labor clauses and the internationally recognized Lloyd's open form.
Because if an oil tanker is actively engulfed in flames in the middle of the ocean, the captain doesn't have time to sit down with a team of corporate lawyers and negotiate an hourly rate for a rescue tugboat.
Absolutely not. The industry relies on standardized, pre-agreed contracts, functioning on the high-stakes principle of no cure, no pay.
Meaning if they fail, they get nothing.
Exactly. Salvage crews can rush out into a hurricane, risking their own lives and multi-million-dollar vessels to save a ship in distress. If they fail, and the target ship sinks, the salvers receive absolutely nothing for their heroic efforts.
Brutal.
But if they succeed in towing the burning hulk to port, the law awards them a massive, generous percentage of the total value of the ship and the cargo they rescued.
Though the text highlights a crucial modern evolution of that ancient rule. What if a salvage crew tries to save a massive oil tanker, fails to save the ship itself from sinking, but successfully deploys booms and prevents millions of gallons of crude oil from devastating a coastal ecosystem?
Under older rules, they'd get nothing because they didn't save the ship. But today, they can still receive substantial compensation. The maritime law has adapted. Preventing environmental catastrophe is now legally recognized as a success worthy of reward.
It is a perfect demonstration of how these centuries-old mathematical formulas are constantly stretching and mutating to underwrite the unprecedented realities of the modern world.
It's an ever-evolving system.
Which brings us to the end of our journey today. We've traced the invisible architecture of risk from the smoky 1680s coffee houses of London, through the chilling moral hazards of life insurance murder cases, into the immediate social safety nets of no-fault vehicular liability, and out into the forced solidarity of maritime salvage.
We covered a lot of ground.
We really did. Insurance is so much more than tedious paperwork and annoying monthly premiums. It is the mathematical courage that allows humanity to build, trade, and bravely face a terrifying, unpredictable future. So what does this all mean for you?
Well, it leaves us staring at a fascinating, almost paradoxical question for our immediate future. The entire premise of everything we've analyzed today relies on one foundational pillar. The risk must be uncertain.
Right.
The texts are explicit. For a valid insurance contract to exist, there must be genuine uncertainty about whether a disastrous event will happen, or at least when it will happen. You cannot insure a house that is already on fire.
The math requires the unknown.
Exactly. But consider the technological era we are rapidly entering. As we integrate advanced big data analytics, comprehensive genetic sequencing, and highly predictive artificial intelligence into our daily lives, we are gaining the terrifying ability to predict our individual health risks, our lifespans, and our localized property risks with near-perfect clinical certainty.
Oh, wow. So we are actively engineering the uncertainty out of human existence.
Yes. So the thought experiment we leave you with is this. If the uncertainty completely evaporates, if an AI algorithm can scan your DNA and your environment and tell you exactly what disease you will contract and precisely when your roof will fail, What happens to the mechanism of insurance?
It's a wild thought.
Right. If risk becomes a certainty, does the entire centuries-old system of mathematically shared disaster that built our modern world simply collapse under the weight of perfect foresight?
If the algorithm sees everything perfectly, the entire mathematical safety net might just shatter. It's a profound paradox to consider the next time you review your policies. Imagine a legal loophole so vast, so completely misunderstood, that it essentially incentivizes a person to murder a 2-year-old child.
I mean, it sounds like the plot of a thriller.
Right.
But it is a very real, very grim piece of legal history.
We're talking about the chilling case of Liberty National Life Insurance Company versus Weldon.
Yeah.
A nurse decides to take out a life insurance policy on her own 2-year-old niece. She pays the premium, the insurance company issues the policy, and shortly after, the aunt actually administers a fatal dose of arsenic to the child.
It's just horrific.
She murdered her own niece to collect a payout.
And, when that case went to court, the prosecution obviously went after the aunt for murder.
Of course.
But the real legal earthquake happened when the court turned its attention to the insurance company. They heavily penalized the insurer in damages.
Because by issuing that policy to someone who had absolute no financial stake in the child being alive.
They didn't just write a bad contract.
Yeah. Exactly. They essentially printed a bounty. Like, they created a financial incentive for murder. And this is the terrifying, chaotic heart of insurance law.
It really is.
Because we usually think of contracts as these clean mathematical equations, I give you money, you give me a house, it's visible, it's safe.
Yes, standard contract law is very grounded.
But insurance, you are drafting legally binding agreements based on the completely unpredictable forces of the universe. You are legislating the unknown.
You're trying to put a rigid legal boundary around fire, storms, human frailty, and sudden death.
Right.
And it is an incredibly delicate balancing act, because if the law gets it wrong, you end up with the Weldon case.
A literal wager on a human life.
Exactly.
So welcome to this deep dive. If you are listening to this right now, there's a very strong chance you are a student or a lecturer gearing up for an insurance law exam.
We are talking directly to you today.
Consider this your ultimate comprehensive audio lecture. Our mission today is to systematically pull apart the incredibly dense study material compiled by the KLE Law Academy Belagavi.
And we're examining all of it.
Every single piece. The history, the core statutory sections, the landmark case laws. We are going to ensure that by the time you walk into that exam hall, you don't just have rote memorization,
Right, you need a profound understanding of how these laws actually function in the real world.
Because the material we have here is monumental. It requires us to travel from the ancient marine loans of the Roman Empire all the way to the cutting-edge statutory tribunals handling chemical disasters in modern India.
We really have to dissect the nature of legal risk itself.
So let's start at the absolute bedrock. Before we analyze complex public liability or marine warranties, we have to look at what this concept legally is.
Okay.
The fundamental function of insurance seems simple enough, right? It's shifting a loss.
Yeah, basic risk transfer.
Like, if my warehouse burns down, I face financial ruin. But if I pay a small premium to a professional risk bearer, that ruinous loss is shifted away from me.
That concept of risk distribution is ancient, but defining it as a valid, enforceable contract under modern law requires a very specific ingredient.
And what is that ingredient?
We find it in a landmark English case, Prudential Insurance Company versus Inland Revenue Commissioner.
Okay, Prudential Insurance.
Yeah. In that courtroom, Channel J delivered a ruling that hinged entirely on one specific requirement, which is uncertainty.
Uncertainty, so the contract is literally void without it.
Precisely, which is the exact opposite of a standard contract, where certainty is the entire goal.
Right. Usually you want everything locked down.
Exactly. But Channel J stated that for an agreement to legally constitute insurance, there must be uncertainty about whether the event will ever happen at all.
Like a shipwreck or a flood.
Right. Or, if the event is an absolute inevitability, like human death, there must be complete uncertainty as to the time it will occur.
Okay, the legal term the text uses here is an aleatory contract.
Aleatory, yes.
It denotes a speculative mutual risk. I am paying a premium based purely on a chance event. But hold on, let me play devil's advocate here, because this is where my brain gets stuck.
Go for it.
If I am putting down cold, hard cash based entirely on uncertainty and chance, I am basically placing a bet against the sky.
Okay, I see where you go.
Like if I buy crop insurance, I am betting the insurance company 100 rupees that a storm will destroy my farm. If the storm hits, I win the payout.
Right.
That is the exact mechanical structure of a casino.
It sounds like it, yeah.
How is this not just a state-sanctioned wagering contract?
That tension you're feeling right now is exactly what plagued early legal scholars.
Really?
Oh, yeah. On the surface, the mechanics are identical. You pay money based on an uncertain future event. To untangle this, we have to look at the philosophy of Sir William Anson.
Ah, Anson, the
So-
absolute titan of the law of contract.
The very same. And Anson initially thought insurance was just permitted gambling.
Wait, he did?
He did. But as he evolved his legal theory, he crystallized the modern distinction. And it all comes down to two things: intent and pre-existing risk.
Okay, intent and pre-existing risk.
Let's look at your casino example. When you walk up to a roulette wheel and place a bet, you are creating a risk out of thin air for the sole purpose of making a profit.
Right, I'm just hoping my number hits.
Exactly.
Yeah.
You had absolutely no financial stake in that little metal ball before you placed the chips. The wager created the risk.
But when I insure my farm, the storm is coming regardless.
The risk of the storm exists completely independent of the insurance contract.
Wow, okay.
You already own the crops. You stand to lose your livelihood. Insurance does not create the risk. It merely mitigates a previously existing risk.
So my intent isn't to walk away richer.
No, your intent is to avoid starvation.
Right.
Anson concluded that the resemblance between a wager and insurance is purely superficial. A wager creates a risk to make a profit. Insurance shifts an existing risk to guarantee security.
That concept, having a pre-existing stake, is the linchpin. And the text calls it insurable interest, which we will dig deep into shortly.
We definitely will.
But first, let's look at how India actually attempted to regulate this chaotic trade of risk. Because you can't just have individuals swapping massive liabilities without the government stepping in.
Definitely not.
The KLE study material breaks the evolution of Indian insurance into 5 distinct historical eras.
Right, starting with the period of mushroom growth.
Yeah, from 1900 to 1912.
So to understand this period, you really have to understand the political climate. The Swadeshi movement was sweeping the nation.
A profound call to boycott British goods and institutions.
Exactly. And this surge of economic nationalism created a massive vacuum in the financial sector, which was then rapidly filled by a boom in domestic indigenous Indian insurance companies.
But the text uses the phrase mushroom growth intentionally, right?
Very intentionally.
It wasn't a stable, deep-rooted forest. It was a chaotic overnight bloom.
Yeah, and it brought in severe economic evils. Wealth started accumulating in the hands of entirely inexperienced promoters.
Oh, no.
These new companies were springing up on street corners without any solid actuarial science behind them,
So they were just guessing.
basically.
Yeah.
They were collecting premiums with absolutely no mathematical proof that they could actually pay out the claims when the time came.
That's a disaster waiting to happen.
It was. So the government was forced to intervene to protect the public. They enacted the Indian Life Assurance Companies Act of 1912.
Which was the first true statutory attempt to force these companies to operate on sound legal footing.
Right, eventually requiring them to publish their returns by 1914 for public transparency.
Which brings us to the second era, struggle and steady growth, from 1913 to 1938.
This window contains the devastating economic slump following the First World War.
So the patriotic boom of the Swadeshi movement collided violently with global economic reality.
Violently. Many of those overnight indigenous offices simply collapsed under the weight of claims and terrible investments.
Yeah.
And the ones that survived.
The ones that survived the World War slump were then brutally squeezed by highly organized, heavily capitalized foreign competition operating in India.
It became a crisis of national economic sovereignty.
It really did.
So the government realized they had to build a fortress around Indian commerce. They appoint a special officer, Sri S.C. Sen, in 1934, and then form a massive investigative committee chaired by Sri N.N. Sarkar in 1936.
The Sarkar Committee was arguably the most consequential body in Indian insurance history.
Really?
Oh, absolutely. Their exhaustive investigation culminated in the Insurance Act of 1938.
Okay, the 1938 Act.
This was a monumental piece of legislation. It didn't just tweak the rules. It established sweeping, uniform government control over every single insurer operating on Indian soil.
Wow.
The regulations were so strict and the compliance so rigorous that a vast number of foreign offices simply threw their hands up and discontinued their Indian operations entirely.
So the fortress worked.
It worked. Which brings us to the third era. Stability and consolidation, 1938 to 1950. The foreign threat is minimized, the surviving Indian offices stabilize, and post-World War II, there is a tremendous amount of capital floating around.
But human nature kicks in.
Exactly. We hit a new crisis, which the text calls malinvestment.
Right. You have these insurance companies sitting on mountains of premium capital.
Okay.
But instead of safeguarding those funds for future claims, executives were investing them wildly.
Oh, no. Like where?
Often in highly speculative ventures or even in their own intertwined corporate interests.
That is basically embezzling public funds through bad investments.
Exactly. So the Kawashijangir Committee was formed in 1945, and their report was a scathing indictment of this malinvestment.
So they had to step in again.
The government had to pass numerous amendments to the 1938 Act just to put a leash on how insurers could invest the public's money.
Add in the agonizing economic disruption of the 1947 partition, and the whole framework needed an overhaul.
Leading to the S.R. Ranganathan Committee and the major amendments of 1950.
That sets the stage for the most dramatic shift. Era 4. Boom in nationalization, 1950 to 1991.
A huge period.
India is transitioning from a heavily agrarian society into a modern industrialized nation, driven by the massive 5-year plans.
And the government looked at the insurance sector and saw two things.
What were they?
A persistent failure by private companies to guarantee absolute security to the public and a colossal reservoir of capital.
They realized those funds were desperately needed to finance the national developmental plans.
Yes, allowing private entities to gamble with that capital was no longer politically or economically acceptable.
So what did they do?
On January 19th, 1956, the government dropped the hammer. They issued an ordinance completely nationalizing the life insurance sector.
The scale of that absorption is staggering. They swallowed 154 Indian insurers, 16 non-Indian insurers, and 75 provident societies.
Fusing them all together into one absolute leviathan.
The Life Insurance Corporation of India, the LIC.
And they applied the exact same philosophy to general insurance a few years later. The General Insurance Business Nationalization Act was passed in 1972.
So they took 107 private general insurers and amalgamated them into 4 state-owned subsidiaries under the General Insurance Corporation of India, the GIC.
Right. And for nearly 40 years, the state held an ironclad monopoly. You couldn't buy a policy from anyone else.
Until the global economic ground shifted again, bringing us to the final era, privatization. From 1991 onwards.
The 1991 economic liberalization policies demanded that India open its markets. A state monopoly was just no longer viable in a globalized economy.
The government established a committee under former RBI Governor R.N. Malhotra in 1993 to chart a new course.
And the Malhotra Committee's 1994 report was unequivocal. The industry had to be reopened to the private sector.
Right.
They recommended allowing foreign companies back in, provided they formed joint ventures with Indian partners.
But you can't just unleash private capital without a very strict referee.
Enter the Insurance Regulatory and Development Authority.
The IRDA Act of 1999 created the modern watchdog. And if you are taking an exam, you absolutely need to know the statutory mechanics of how this watchdog operates today.
Definitely. If a new private player wants to enter the Indian market, they have to navigate Section 3 of the Insurance Act 1938 as amended by the IRDA Act.
Section 3 is the ultimate gatekeeper. It explicitly prohibits any person from carrying on any class of insurance business without a certificate of registration from the authority.
The days of mushroom growth are completely dead.
Right.
To get that certificate, you must submit exhaustive documentation, certified copies of your memorandum, deep background checks on your directors, proof of massive foundational capital deposited securely with the Reserve Bank of India.
And a rigorous certificate from a qualified actuary proving your life insurance premium rates are mathematically sound.
It's a colossal barrier to entry.
And it is a recurring toll. Section 3A dictates that this registration must be renewed annually. Let's look at the fees because they highlight the scale of the industry.
Under Section 3A, the annual renewal fee is capped, but the cap is astronomically high.
How high?
It cannot exceed 1/4 of 1% of the total gross premium written direct in India during the financial year, or rupees 5 crores, whichever is less.
5 crores just to keep the lights on for another year?
Yeah.
But the IRDAI isn't just toll booth collecting fees, right? Section 14 of the IRDA Act 1999 outlines the functions of this 10-member body, and it is a massive list of responsibilities.
Section 14 is fundamentally about consumer protection. Yes, they issue and modify registrations, But more importantly, they protect the interests of the policyholders.
In matters concerning assigning of policy, nomination, and claim settlement.
Right. They lay down a strict code of conduct for agents and surveyors. They fiercely regulate the investment of funds.
Learning the hard lessons of the 1940s malinvestment crisis.
Exactly. They specify the margin of solvency, mathematically guaranteeing that a company has enough liquid cash to pay out catastrophic claims.
They even act as a tribunal adjudicating disputes between insurers and intermediaries.
They do it all.
Okay, so now that we understand the historical and regulatory arena, we have to look at the actual rules of the game.
The foundational principles.
Yes. Let's pivot to the foundational legal principles of insurance. These are the universal laws governing the contracts between the giant insurers and the everyday citizen.
And the most vital concept, the one that separates insurance from a casino, like we discussed, is insurable interest.
Without insurable interest, the contract is legally void. It is classified as a wager.
Right. We define insurable interest as a pecuniary, meaning financial relationship between the insured and the subject matter of the insurance.
So the insured must financially benefit from the safety of the property, and they must be financially prejudiced or suffer a loss by its destruction.
Exactly.
Let me test this with a scenario.
Go ahead.
I live next door to a massive, beautiful mansion. I love looking at it. I think to myself, well, if that mansion burns down, I will be heartbroken. I'm going to take out a 10-core fire insurance policy on it.
The insurer will reject your proposal immediately. And if they somehow accepted it, a court would void it.
Why?
Because you have an emotional interest in the mansion, perhaps an aesthetic one, but you do not have a pecuniary interest.
Ah.
If the mansion burns to ashes, your personal bank account is completely unaffected. You suffered no financial prejudice.
So I can't insure it.
No. You only have an insurable interest in your own property, where a fire actually diminishes your net worth.
The concept is clear. But here is the massive trap for students preparing for the exam. The timing of when that insurable interest must exist is entirely fluid depending on the specific branch of insurance you are dealing with.
The timing distinctions are highly critical. Let's examine life insurance first. In a life policy, the law dictates that the insurable interest must exist only at the commencement of the policy.
Wait, only at the beginning? That feels counterintuitive.
It does, until you look at commercial realities. Let's say a bank loans a business owner 50 lakhs. The bank has a massive insurable interest in the life of that business owner.
Because if she dies tomorrow, the bank loses its money.
Exactly. So the bank takes out a life insurance policy on her. 10 years later, the business owner completely pays off the loan.
Okay, so the bank's insurable interest is now zero.
Right. However, if the bank decides to keep paying the monthly premiums and the business owner dies 20 years later, the bank is legally entitled to collect the entire death benefit.
Wow, really?
Yes, because the law only requires that the interest was valid on the day the ink dried on the contract.
That is fascinating. Okay, what about protecting property? Fire insurance.
Fire insurance demands a much tighter leash. The insurable interest must exist at both the commencement of the policy and at the exact time of the loss.
So if I insure my house, but then I sell it to someone else on a Tuesday and it burns down on a Wednesday?
You received nothing.
Wow.
You had interest at commencement, but the moment you transferred ownership on Tuesday, your interest evaporated. You cannot claim an indemnity for a house you no longer own.
And the buyer can't claim on my policy either.
No, because they didn't have the contract at commencement.
So life is beginning, fire is beginning and end. Where does marine insurance fall?
Marine insurance is the pragmatic outlier. The insurable interest must exist at the time of the loss. It does not strictly need to exist when the policy is taken out, provided there was a bona fide expectation of acquiring an interest.
Why the leniency at the start?
Because of the nature of global trade. Cargo on a ship crossing the Pacific might be bought and sold 5 times while it's in transit.
Oh, right.
The person who happens to hold the bill of lading the exact moment the ship sinks is the one who suffers the devastating financial hit. The law recognizes that fluid reality.
The person holding the loss at the end is the one who needs the protection. Okay, principle number 2 is the principle of indemnity.
Indemnity is the bedrock rule that insurance compensates you solely for the actual loss suffered. The entire mechanism is designed to prevent the insured from making a profit from a disaster.
I always visualize indemnity as a financial reset button.
That's a good way to look at it.
If my car is worth 5 lakhs and I crash it into a tree, the insurance company presses the reset button. They give me the exact financial equivalent of a used 5 lakh rupee car.
Yes.
They do not upgrade me to a 10 lakh rupee luxury sedan. If they did, I would have a financial incentive to go out and intentionally crash my car.
Your analogy is perfect. The law absolutely abhors creating incentives for destruction. And to enforce this strict reset button, the principle of indemnity has two vital corollaries: subrogation and contribution.
Subrogation always sounds like a villain in a sci-fi movie. Let's break it down. Suppose someone blows through a red light and completely totals my car. My insurance company pays me the 5 lakhs for my destroyed vehicle. I am indemnified.
Oh.
Now, I want to take the guy who ran the red light to court and sue him for 5 lakhs too.
The law of subrogation stops you instantly. Once your insurer hits that reset button and makes you whole, your personal right to sue the negligent driver is immediately transferred or subrogated to the insurance company.
So I can't double dip.
Exactly. You cannot collect 5 lakhs from your insurer and another 5 lakhs from the driver. That would be a profit. The insurer essentially steps into your shoes, goes to court, and sues the driver to recover the money they just paid you.
Makes total sense. And what about contribution?
Contribution kicks in when you try to outsmart the system by taking out multiple policies on the same asset.
Okay, let's say my warehouse is worth 10 lakhs. I buy a 10 lakh policy from insurer A and another 10 lakh policy from insurer B. The warehouse burns down. I file a claim with both, expecting a 20 lakh payday.
But your actual loss is only 10 lakhs.
Right.
The principle of contribution dictates that you cannot recover more than the actual loss. The two insurers will communicate, and they will each pay a rateable proportion.
So insurer A pays 5 lakhs, insurer B pays 5 lakhs.
Yes, you are indemnified, but you do not profit.
Got it. Okay, our third foundational principle comes with a heavy Latin mandate. Uberi mai fide, utmost good faith.
This one fundamentally alters how a contract is negotiated.
Because in everyday commercial transactions, say I'm buying a used tractor from a farmer, the governing legal maxim is caveat emptor, let the buyer beware.
Exactly.
If I don't get down in the mud and check if the transmission is leaking oil, the farmer isn't legally obligated to volunteer that information. It's on me to investigate.
But an insurance contract flips that dynamic completely. It is dominated by uberi mai fide. Think about the massive imbalance of information.
Right. The insurer has no idea about the hidden condition of my heart.
Or the faulty wiring inside the walls of your factory. They are pricing a massive risk, entirely blind, relying solely on what you tell them.
So the law steps in.
Therefore, the law imposes a stringent, inescapable duty on the insured to voluntarily disclose all material facts before the contract is signed.
The obvious question for an exam is, what makes a fact material?
The legal test is whether the circumstance would influence the judgment of a prudent insurer in fixing the premium or in deciding whether to accept the risk at all.
Give me an example.
If you are applying for life insurance and you know you experience severe chest pains, that is a material fact. If you fail to disclose it, even if the non-disclosure is entirely innocent, maybe you convinced yourself it was just heartburn, the insurer has the legal right to declare the policy voidable.
That's incredibly strict, but the syllabus highlights that there are limits to this, right? There are 4 specific exceptions where the duty of disclosure is waived.
The law doesn't require you to be redundant. You are excused from explicitly disclosing first what the insurer already knows. Second, what the insurer ought to know. If you are insuring a ship heading into a well-known active war zone, you don't need to inform the insurer that wars are dangerous. That is common knowledge in their ordinary course of business.
Okay, that's 2.
Third, information that the insurer explicitly waives. If they don't ask about your grandparents' medical history on the form, you don't have to force the documents on them.
And the 4th exception is my favorite. You don't have to disclose facts that actually lessen the risk.
Correct. If you secretly install a $1 million biometric fire suppression system in your warehouse, you aren't legally required to tell the fire insurance company.
Because I'm basically paying a higher premium than I need to.
Yeah, you haven't hidden the danger from them.
All right, we have insurable interest, indemnity, and utmost good faith. The final piece of the foundation is proximate cause, or causa proxima.
In any loss, there's usually a chain of events. The law defines the proximate cause as the active, efficient cause that sets in motion a train of events bringing about a result without the intervention of any force started and working actively from a new and independent source.
It's essentially identifying the real culprit.
Exactly.
Like if a spark starts a fire in my factory and the fire weakens a structural beam and the beam collapses, crushing my expensive generator.
Okay, good scenario.
The immediate physical cause of the broken generator is a falling steel beam. But the proximate cause, the efficient cause that started the whole chain, is the fire.
Right, so if you have fire insurance, you're covered. It is not necessarily the cause that is closest in time or space, but the cause that is supreme in effectiveness.
Okay, we've established the universal rules. Let's apply them to the most complex subject matter possible, human life. We are looking at life insurance, where the neat mathematics of the indemnity principle completely break down.
They absolutely shatter.
Because how do you put a definitive price tag on a father or a business partner?
It took the courts decades to figure this out, and it is perfectly illustrated by two historic English cases that students must know. The first is Godsall versus Boldero from 1807.
Okay, what happened in Godsall?
In this era, Lord Mansfield viewed life insurance through the exact same lens as property insurance. He ruled that life insurance was a strict contract of indemnity.
Wait, really?
Yes. He said if a creditor insured a debtor's life, and the debt was somehow paid by a third party after the debtor died, the creditor couldn't collect the insurance money because they had suffered no ultimate financial loss.
Lord Mansfield was treating a human life like a warehouse.
Exactly. And society couldn't accept that.
I can imagine. It led to severe criticism.
It did. The breakthrough came nearly 50 years later in the landmark case of Dalby versus the India and London Life Assurance Company in 1854.
The Dalby case.
Yes, the judges in Dalby recognized a fundamental philosophical truth. Human life is intrinsically incapable of exact financial estimation. You cannot replace a life the way you replace a burned-down tractor.
So what do they decide?
They overturned Godsall and established that life insurance is not a contract of indemnity.
Wow.
It is a contingent contract. You agree to pay premiums, and the insurer agrees to pay a definite, pre-agreed sum of money upon the happening of a certain event, death. You are assuring a payment, not indemnifying a physical loss.
But even though it isn't strict indemnity, underwriters still have to evaluate the risk of that certain event happening sooner rather than later.
Of course.
Like when I apply for life insurance, they want my age, my family's medical history, my blood pressure.
They're evaluating physical and occupational hazards. A commercial airline pilot faces very different risks than an office manager, but they are also deeply concerned with moral hazard.
Which brings us back to willful misconduct and the darkest corner of this subject. We started the discussion with the Weldon case, the aunt poisoning her niece.
Right.
The legal philosophy is clear. No individual shall be allowed to take advantage of their own wrong. It is an implied term of every life insurance policy that the beneficiary will not murder the insured to trigger the payout.
But the complexity arises with suicide. What if the insured intentionally takes their own life?
Right. The legal term for that is felo de se, or a felon of himself. The guiding historical case here is Bordale versus Hunter.
And this is a very tricky area of law.
If someone is in profound distress and they take out a massive life insurance policy with the specific intent of committing suicide a week later to leave their family wealthy, that is a massive fraud against the insurer.
It is, and historically, under cases like Bordale, any death by suicide would void the policy entirely. But modern law recognizes the nuance of mental health and long-term policies.
How so?
To balance the prevention of immediate fraud with the compassionate need to protect a family over the long term, modern policies utilize a suicide exemption clause.
How long is the exemption?
Generally, if the insured commits suicide within 1 or 2 years from the commencement of the policy, the insurer is not liable to pay the sum assured, though they will typically refund the premiums paid.
And after that?
If the suicide happens after that initial exemption period, the policy pays out normally. The logic is that a person rarely plans a fraudulent suicide 2 or 3 years in advance.
That's a pragmatic balance. Let's look at the mechanics of how the money actually changes hands. The Insurance Act, 1938, governs this through Section 39, which deals with nomination.
Section 39 is crucial. It allows the policyholder to officially nominate a person to receive the policy money in the event of their death.
This is done via an endorsement on the policy document itself, which must be registered with the insurer.
Exactly. It bypasses the need for a messy will or probate court for this specific asset.
But the study material highlights a critical conflict here, a trap for the unwary. It's the clash between Section 39 nomination and Section 38 assignment.
This is heavily tested in exams, so listen closely. Suppose a husband nominates his wife under Section 39 to receive his life insurance. 10 years later, his business hits a rough patch. He needs a loan from the bank.
Okay.
The bank demands collateral. So under Section 38, he formally assigns the rights of his life insurance policy to the bank.
What happens to the wife's nomination?
Subsection 4 of Section 39 dictates that the assignment automatically cancels the previous nomination.
Oh, wow. So it's just gone.
Yes. The bank is now the sole legal payee. The wife's right to the money is extinguished the moment the assignment is registered.
Is there any exception?
There is one narrow exception. If the policyholder assigns the policy directly to the insurer themselves for a loan against its surrender value, the nomination is only affected to the extent of the insurer's loan. But an outside assignment wipes the nominee out.
What if the tragedy happens in reverse? What if the nominee dies while the policyholder is still alive and well?
Under subsection 5, a nominee does not acquire an absolute vested right to the money while the policyholder lives. They merely have an expectancy.
So if the nominee dies first,
The nomination becomes void. The policy amount simply becomes payable to the policyholder's legal heirs or the holder of a succession certificate upon the policyholder's eventual death.
before we move off life insurance, we have to talk about the math. How does an insurer calculate how much a life is actually worth in premium terms? The concept is human life value, or HLV.
HLV is an economic formula to estimate the financial crater your death would leave behind. It's basically a two-step calculation.
Walk us through it.
First, you project your family's ongoing expenses, grocery bills, utility costs, your children's future education, lifestyle maintenance.
Okay.
Second, you calculate all your outstanding liabilities, the remainder of your mortgage, car loans, personal debt. Add those massive figures together, and that sum is your human life value.
That is the target amount of life insurance you need to buy to ensure your family isn't financially destroyed.
Exactly. And the market offers a spectrum of products to reach that number. Term insurance is the purest form.
It has zero savings component, right? It's just pure risk cover for a set period, making the premiums incredibly cheap.
Correct. Conversely, you have endowment plans, which combine life cover with a mandatory savings component. If you survive the term, you get a maturity benefit.
And money-back policies.
They are a variation that provide periodic lump sum payouts during the life of the policy. Whole life policies discard the term entirely and cover you until your eventual death. And for those willing to link their savings to market volatility, there are unit-linked insurance plans, or ULPs.
We've covered protecting your own life. But the legal framework shifts dramatically when your actions accidentally harm a total stranger.
Very true.
We are entering the territory of third-party rights, motor, and public liability. Let's look at the Motor Vehicles Act, 1988, specifically Section 140.
Section 140 is a masterpiece of pragmatic, compassionate legislation. It introduces the principle of no-fault liability.
Now, I have to push back on this because no fault sounds like a recipe for absolute legal chaos.
I get that a lot.
In standard tort law, if I want you to pay my medical bills, I have to prove to a judge that you were negligent. I have to prove it was your fault. If we remove fault, what stops a fraudster from intentionally jumping onto the hood of a wealthy person's Mercedes just to collect a guaranteed payout? Doesn't no fault invite massive abuse?
It's a valid concern, and it's the reason standard tort law insists on proving negligence. But Parliament looked at the reality of Indian roads and the agonizingly slow pace of the judicial system.
Which can take forever.
Proving fault in a traffic accident can take a decade in court. Witnesses disappear, police reports are vague. Meanwhile, the victim, often the sole breadwinner of a poor family, has died or lost their legs, and the family is starving today.
Oh, I see.
Section 140 makes a philosophical choice. Swift, guaranteed survival relief is more important than perfect, protracted justice.
So how does it bypass the blame game?
Section 140 mandates that where death or permanent disablement results from the use of a motor vehicle, the owner of that vehicle is jointly and severally liable to pay compensation. The critical phrase is that the claimant does not need to plead or establish that the accident was due to any wrongful act, neglect, or default by the vehicle owner.
Wow. So even if the victim was jaywalking, the payout is triggered.
Yes.
But the payouts are capped to prevent the exact fraud I mentioned.
Precisely. Because it is a guaranteed payout without proving fault, it is not meant to be a windfall. It is survival money. The statute fixes the sum at Rs. $50,000 for death and Rs. $25,000 for permanent disablement.
It's an immediate financial tourniquet. while the family can later pursue a larger fault-based claim under other sections if they choose.
Exactly.
That addresses the chaos of the roads. But what about the chaos of an industrial disaster? Let's analyze the Public Liability Insurance Act, 1991. The historical context here is unavoidable. The shadow of the Bhopal gas tragedy hangs over this entire piece of legislation.
Absolutely. When hazardous industries operate near population centers, the risk profile changes from an individual accident to a catastrophic public event.
Right.
The 1991 Act recognized that factory workers might be covered by workers' compensation, but the innocent citizens living outside the factory walls had zero protection.
So what did the act do?
This act made public liability insurance absolutely mandatory for any owner handling hazardous substances, as defined strictly under the Environment Protection Act. Operating without it is a criminal offense.
Let's explore the financial mechanics. If I run a chemical processing plant, how much insurance is the government forcing me to buy?
Section 4, subsection 2A sets the minimum threshold. Your policy amount cannot be less than the paid-up capital of your specific undertaking.
So if I have a 10-crore facility, I need a minimum 10-crore policy.
Yes. However, to keep premiums commercially viable, the maximum limit is statutorily capped at Rs 50 crores.
And the policy is structured around two key ratios, AOA and AOY.
This is how insurers contain their exposure. AOA stands for any one accident. It is the absolute maximum the insurer will pay out for a single disastrous event.
And AOY?
AOY stands for any 1 year, which is the aggregate limit for all accidents occurring within that policy year. Companies typically negotiate ratios like 1 to 3.
So if your AOA is 5 crores, your AOY is 15 crores.
Right, ensuring that a second disaster in the same year doesn't leave the public entirely unprotected.
But the brilliance of this act is how the claims are handled. It explicitly avoids sending thousands of victims into the labyrinth of the civil courts.
The act empowers the district collector to act as the primary adjudicator. The collector can verify the occurrence of the accident within their jurisdiction, publicly invite applications, conduct summary inquiries, and issue an award of relief rapidly.
There is a strict 5-year statute of limitations to file a claim, and the relief isn't arbitrary, it's codified.
The schedule to the act acts as a fixed menu of relief. Rs. $25,000 per person for a fatal accident, plus up to Rs. $12,500 for medical expenses.
The same amounts apply for permanent total disability too, right?
Yes. It also covers private property damage up to Rs. $6,000. It even provides a specific wage loss mechanism for temporary disability, offering up to Rs. $1,000 per month for a maximum of 3 months.
And if a wealthy factory owner decides to just flout the law and not buy the policy?
Section 14 brings the hammer down. Non-compliance is punishable with mandatory imprisonment for a term not less than 1 year and 6 months, extending up to 6 years, or a minimum fine of 1 lakh rupees, or both.
And a second offense elevates the minimum prison sentence to 2 years.
The state will not tolerate uninsured hazards.
Let's leave the industrial sector and move into the rural heartland. We are applying these sophisticated insurance principles to the absolute backbone of India's economy, agriculture, starting with cattle insurance.
For a marginal farmer, a milch cow or a working bullock isn't just an animal, it is their primary economic engine.
The sudden death of that animal can plunge a family into generations of predatory debt.
Exactly. Cattle insurance was designed as a systemic shield for the agro-based economy.
The policy covers death, but also permanent disability. However, the legal definition of disability here is strictly functional.
It's evaluated purely on economic utility. If a milch cow is injured and permanently loses the capacity to conceive and yield milk, it is a total economic loss to the farmer, and the policy pays out.
For a stud bull, the trigger is the permanent incapacity to breed. But dealing with livestock introduces a massive element of moral hazard. How does an insurer operating from a city office know that a farmer's cow actually died, or that it wasn't just a sick 20-year-old cow to begin with?
Insurers impose brutal eligibility and identification parameters. Age limits are strict. Milch cows are typically only insured from their first calving up to 10 years of age. Stud bulls from 3 to 8 years.
Okay, but how do they identify them?
The ultimate anti-fraud weapon is the ear tag. An authorized veterinary doctor must jointly inspect the animal with the owner, and a tamper-proof identification tag is affixed to the ear.
So if the animal dies...
The absolute first requirement for a claim is the physical production of that specific ear tag. No tag, no claim.
Wow. And the exclusions are designed to enforce proper animal husbandry.
Yeah. The insurer will not pay for death caused by gross neglect. If the animal gets sick and you fail to call a vet, your claim is denied.
What else do they exclude?
They explicitly exclude death from intentional overloading. Using the animal for unauthorized purposes, clandestine sale where a farmer sells the cow and pretends it died, and of course unauthorized slaughter.
Expanding from a single cow to massive fields, we look at crop insurance. The current flagship program is the PMFBY, the Pradhan Mantri Fasal Bima Yojana.
Launched in 2016, the PMFBY was built to solve the affordability crisis of previous schemes. It established highly subsidized, flat premium rates across the entire country. 2% for Kharif crops, 1.5% for Rabi crops, and 5% for commercial and horticultural crops.
This was a massive evolution from older, flawed models. The material highlights the FIWAs from 2003, which attempted to ensure both crop yield and market price, creating an unsustainable financial burden that led to its swift withdrawal.
Right. But the more important conceptual leap is the area approach pioneered by the NAIs in 1999.
Tell me about the area approach.
The area approach is a brilliant logistical solution. Imagine a monsoon fails across an entire state. If an insurer had to send an individual surveyor to manually assess the yield loss on 5 million tiny individual farm plots.
The administrative cost would exceed the payouts?
Exactly, and it would take years. Instead, the area approach defines a geographical unit, say a Gram Panchayat. The government measures the average yield of that specific area based on sample crop cutting experiments.
So if the average yield of the area falls below a guaranteed threshold due to drought,
every single insured farmer in that area automatically receives a proportional payout, entirely bypassing the need for individual farm inspections.
it sacrifices micro-level precision for macro-level speed and efficiency. That's so smart. Let's pivot from the fields to the physical infrastructure. We're looking at fire insurance and property risks. The legal definition is anchored in the English case Castellan versus Purton.
Cotton LJ delivered the defining quote here. He stated that fire insurance is a contract whereby one person undertakes in return for agreed consideration to indemnify another person against loss or damage occasioned by fire up to the agreed amount.
There is that concept again, strict indemnity. But modern fire policies cover significantly more than just flames. The industry standard is an acronym, STFI.
STFI stands for Storm, Typhoon, Flood, and Inundation. It's a comprehensive natural disaster blanket.
Standard policies also cover lightning strikes, explosions, riots, and quite specifically, damage from missile testing operations.
But the exclusions are equally specific.
What's excluded?
You are not automatically covered for fire damage if the fire was initiated by an earthquake that requires a specific premium add-on. Underground fires are excluded too.
But the most legally interesting exclusion is spontaneous combustion.
Oh, yeah.
Like, if you pile a massive heap of oily rags in a corner and chemical oxidation causes it to heat up and burst into flames on its own, the insurer will deny the claim.
Because that is considered an inherent vice of the material itself, not an external accidental peril.
Now, I want to spend a lot of time on this next concept because it is mathematically ruthless, and it trips up students constantly. It is called the average clause.
Oh, the average clause.
Let's build a scenario. I own a commercial bakery. The building and the ovens are worth exactly 10 lakh rupees. But I'm looking at my budget and I want to slash my overhead. So I go to the insurer and I only buy a policy for 5 lakh rupees.
So you are intentionally underinsured by 50%.
Exactly. 6 months later, an electrical fire burns down half the bakery. The surveyor calculates the exact damage. 5 lakh rupees. I think to myself, perfect. I suffered 5 lakhs in damage. My policy limit is 5 lakhs. The insurer will write me a check for the full 5 lakhs.
If the insurer did that, the entire economic foundation of the insurance industry would collapse.
Why?
Everyone would underinsure their properties to save on premiums, betting that a fire rarely destroys 100% of a building. This is exactly why the average clause exists. It is designed to aggressively penalize underinsurance.
So walk me through the math of the penalty.
The insurer looks at your property and says, well, you chose to insure only 50% of the true value of your asset. By making that choice, you legally became your own co-insurer for the remaining 50%.
Okay.
Therefore, when a loss occurs, the insurance company will only pay out 50% of the claim.
Wait, I suffered a 5 lakh rupee physical loss.
And you will only receive a 2.5 lakh rupee check. The average clause forces you to bear the exact proportion of the loss that you failed to insure.
That hurts.
It ensures that the premium pool accurately reflects the true total risk exposure of all the properties insured.
It is a brutal math lesson, but it enforces honesty in valuation. Now, the material outlines specific variations of fire policies for different commercial needs. Let's contrast a declaration policy with a floater policy.
A declaration policy is built for businesses holding volatile inventory like an electronics distributor. In November, there are warehouses packed with 10 crores of stock for Diwali. In February, it might only hold 2 crores.
It's unfair to charge them a premium based on 10 crores all year round.
So they take out a provisional sum insured. Every month, they submit a formal declaration of the highest stock value held that month. At the end of the year, the insurer calculates the average of those declarations.
And if the average was lower than the provisional estimate, the business gets a proportional refund on their premium.
Exactly. And a floater policy solves a geographical problem.
How?
If you have 5 smaller warehouses scattered across a city, managing 5 separate, fluctuating policies is an administrative nightmare. A floater policy establishes one massive sum insured that literally floats over all 5 specified locations.
Covering the stock wherever it happens to be distributed at the moment of the fire.
Precisely.
The final distinction in property insurance sounds like semantics, but it is a massive financial difference. Replacement value versus reinstatement value.
This is the difference between a depreciated check and a physical reconstruction.
Explain that.
If you have a standard replacement value policy on a 20-year-old factory and it burns down, the insurer calculates the cost of a new factory, subtracts 20 years of heavy depreciation, and hands you a relatively small check.
I likely won't have enough capital to actually rebuild.
No. But a reinstatement value policy is a premium clause where the insurer agrees to throw depreciation out the window. They commit to physically restoring or rebuilding the property to a condition equal to its state when new.
That's a huge difference. Okay, we have arrived at the final frontier. We are leaving the land and heading into the most ancient, complex, and ruthless arena of risk: marine insurance.
This is where modern insurance was really born. While it has roots in the maritime loans of the Greeks and Romans, the sophisticated mechanics we study today were forged in the 1680s in Edward Lloyd's coffee house on Tower Street in London.
Ship captains, wealthy merchants, and financiers would just gather over coffee.
Yeah. A merchant would pass around a document detailing a ship's intended voyage and cargo. Individuals willing to take a fraction of the risk would write their name underneath the proposal, literally becoming underwriters.
Oh, that's where the word comes from. Those coffeehouse agreements eventually solidified into rigid laws, culminating in India as the Marine Insurance Act in 1963. And the rules of the sea are fundamentally different from the rules of the land.
Very different.
Let's look at warranties. In normal contract law, a warranty is a secondary promise. If I buy a high-end laptop and the contract has a warranty that the battery lasts 10 hours, but it only lasts 5, I don't rip up the contract and throw the laptop away. I sue the company for the cost of a new battery. The underlying contract survives.
Right.
But the text says marine warranties are the exact opposite.
They are absolute and they are completely unforgiving. Sections 35 to 43 of the MIA 1963 govern this. In marine insurance, a warranty is a promissory condition where the assured undertakes that a particular thing shall or shall not be done, or that a specific condition will be fulfilled.
And if the captain breaks that promise?
The insurer is instantly, automatically discharged from all liability from the exact date of the breach. And here's the brutal part. It is utterly immaterial whether the breach had any causal connection to the eventual loss.
I need an example to process how strict that is.
Okay, let's say a ship owner warrants that their vessel will sail with a specialized navigator on board. At the last minute, the navigator gets sick and the ship leaves port without him. The warranty is breached at that exact second.
Okay.
3 weeks later, the ship is struck by an entirely unpredictable rogue wave and sinks. The lack of a navigator had absolutely nothing to do with the rogue wave.
But under marine law?
The insurer pays nothing. The contract was legally voided the moment the ship cleared the harbor without the required personnel.
That is terrifying. And you don't even have to write all these warranties down. The law implies them.
Yes, implied warranties are silent but deadly. Section 41 implies a strict warranty of seaworthiness. The law dictates that at the commencement of the voyage, the ship must be reasonably fit in all respects to encounter the ordinary perils of the sea.
If it sails with a rusted hull, the insurance is void.
Yes. Section 43 implies a warranty of legality. If the adventure involves smuggling or violating international sanctions, the policy is legally unenforceable.
But I noticed a very specific caveat in Section 42 regarding the cargo.
It's a very important distinction. There is an implied warranty that the ship is seaworthy, but there is absolutely no implied warranty that the goods themselves are seaworthy.
Oh, okay.
If a merchant ships a load of fresh fruit that naturally rots halfway across the Atlantic, the insurer of the goods isn't automatically off the hook for a breach of warranty, though they may deny the claim under the principle of inherent vice.
Another rigid rule is the concept of deviation under Section 48.
A voyage policy insures a ship from point A to point B along a customary route. If the captain, without a lawful excuse, deviates from that route, the insurer is discharged from liability the moment the ship turns off course.
It does not matter if the ship safely regains its proper route a day later. Once you step off the insured path, the coverage vaporizes.
Exactly.
But surely the law doesn't demand a captain sail blindly into a hurricane just to stay on a line drawn on a map.
No. Lawful excuses are codified in Section 51. A deviation is excused if it is necessary for the safety of the ship or if it is caused by circumstances beyond the master's control.
That's a relief.
But most importantly, the law honors the sanctity of human life. A deviation is completely lawful if it is for the purpose of saving human life or aiding a ship in distress where human lives may be in danger. The insurer cannot penalize a captain for attempting a rescue.
Let's talk about the destruction of the ship. The terminology for losses is very specific. We have actual total loss versus constructive total loss.
Actual total loss under Section 57 is physical annihilation. The ship is smashed into splinters on a reef, or it sinks into the Marianas Trench where the owner is irretrievably deprived of it.
It also applies to cargo that changes its essential nature, right? Like a shipment of cement that gets flooded and turns into solid concrete blocks. It is no longer the thing insured.
Exactly. Now, constructive total loss under Section 60 is more conceptual. It's an economic calculation.
How does that work?
The ship might still be physically floating, but she is stranded on a distant reef, heavily damaged. The owner calculates the cost of hiring salvage tugs, towing her to a dry dock, and repairing the massive holes in the hull.
And if that total cost exceeds the market value of the ship once she is fully repaired,
it makes zero economic sense to save her. She is constructively a total loss, and the owner can abandon her to the insurer and claim the full policy amount.
think of the U.S. Navy in World War II. They had ships hit by kamikazes that were still afloat, but towing them back across the Pacific and spending months repairing them was strategically and economically unviable. They designated them constructive total losses, stripped the weapons, and scuttled them.
A perfect historical application of the economic reality overriding the physical reality.
Finally, we have to decode the most confusing word in marine insurance: average. Because we just talked about the average clause in fire insurance, which was a math penalty for underinsurance. In marine insurance, it means something entirely different.
In the ancient language of the sea, average simply translates to a partial loss or an apportionment of a loss, and it comes in two distinct forms: general average and particular average.
Let's break down general average. The text describes it as a voluntary sacrifice.
General average is a profound ancient maritime tradition. Imagine a ship is caught in a horrific typhoon. It is taking on water and is about to sink, destroying the vessel and all the cargo on board.
Okay, high stakes.
To save the entire adventure, the captain makes a desperate, intentional decision. He orders the crew to throw heavy cargo overboard to lighten the ship.
Jettisoning.
Yes. Now let's say the crew throws Merchant A's shipment of steel beams into the ocean. The ship stabilizes, survives the storm, and reaches port safely with Merchant B's silk and Merchant C's spices completely intact.
Well, it would be a catastrophic injustice for Merchant A to absorb a 100% financial loss, effectively paying the price for Merchant B and C's survival.
So the law forces a redistribution of the pain. Under general average, because Merchant A's property was intentionally sacrificed to save the whole, all parties who survive the venture, the ship owner, Merchant B, Merchant C, must contribute a proportional amount of money to compensate Merchant A.
If your property was saved by the sacrifice, you must pay your share of the cost. I've always thought of it as forced maritime socialism. We survive the storm together, we pay for the survival together.
It's an elegant definition. And particular average is the exact inverse. It is a partial loss caused purely by an accidental peril of the sea, and the financial burden falls entirely on the owner of the damaged property.
So if a massive wave randomly crashes over the deck and ruins only Merchant B's silk, and it was not a voluntary sacrifice to save the ship,
that is a particular average. Merchant B's insurer pays for the silk, and neither the ship owner nor the other merchants contribute a single rupee.
The final pages of the material touch on the terrifying moments right after a disaster strikes: the sue and labor clause and the frantic world of marine salvage.
A sue and labor clause essentially promises the ship owner that if they incur reasonable expenses trying to minimize a loss, like hiring emergency pumps to keep a damaged ship afloat, the insurer will reimburse those costs, even if the ship ultimately sinks.
It incentivizes the owner to fight for the ship rather than just giving up. But what if they need outside help? What about the professional salvage crews? The text mentions the Lloyd's Open Form.
The Lloyd's Open Form, or LOF, is a legendary salvage contract based on a high-stakes premise: no cure, no pay. When a ship is burning, professional salvers will race to the scene.
And if they fail?
If they attempt to rescue and fail, and the ship sinks, they get paid absolutely nothing for their massive expenditure of fuel, equipment, and risk.
That's brutal.
But if they succeed, they don't charge an hourly rate. An arbitration panel in London awards them a massive percentage of the total value of the ship and cargo they saved.
But if I'm a salver and I pull up to a burning oil tanker that looks like it's about to break in half, I might do the math and say, well, the odds of success are too low. If I fail, I bankrupt my company. I'm turning around.
But if you leave, millions of gallons of oil destroy the coastline.
Right.
Which is exactly why the maritime industry had to evolve.
Yeah.
They introduced scopic terms, the Special Compensation P&I Club clause, to supplement the LOF.
How does scopic change things?
Scopic creates an environmental safety net. It guarantees that if a salver attempts to rescue a vessel threatening environmental damage, even if the rescue is completely unsuccessful and the ship sinks, the salver will at least be reimbursed their out-of-pocket expenses plus a 25% markup.
So it financially guarantees that salvers will intervene to prevent ecological catastrophes, removing the no cure, no pay risk when the environment is on the line.
Yes.
We have covered an immense amount of ground today. We started by dissecting the core requirement of uncertainty and Anson's philosophy on pre-existing risk.
We traced the turbulent, century-long history of the Indian insurance market, from the chaotic mushroom growth of the Swadeshi era through the monolithic nationalization of LIC, right up to the modern regulatory fortress of the IRDI.
We examined the rigid timing of insurable interest, the unforgiving math of the average clause, the philosophical debate of valuing a human life in Dolby, the compassion of no-fault motor liability, and the ancient, unyielding warranties of the high seas.
It is a massive syllabus.
As you close your books and prepare to walk into your exam, I want to leave you with one final thought. As you are memorizing the subsections of Section 39 for nomination, or trying to calculate the AOA and AOY ratios for public liability, wait, let me rephrase that. As you study all these sections, do not let this material become just a dry list of statutes and financial calculations.
It is much more profound than that.
It is. Insurance law is, at its absolute core, humanity's legal framework for dealing with the fundamental chaos of the universe.
Absolutely.
Every single section of the Insurance Act we discussed, every strict implied warranty in a marine policy, every morbid, chilling case law about an ant poisoning a child exists for one specific reason. Because someone, somewhere, tried to put a neat, enforceable legal boundary around the wildly unpredictable forces of fire, the sea, human frailty, and sudden death. We cannot stop the chaos of the world. But through the intricate, imperfect mechanisms of this law, we can write a contract to survive it. Good luck on your exam.